Hello and welcome to the next in our series of videos for paper FA1, and this video will be related to the elements of financial statements. We're on page 16 in the express notes, which you can download from www.theexpgroup.com. Please have them open and let's look at what the chapter tells us. Elements of financial statements. According to International Financial Reporting Standards, there are 5 elements of financial statements. This is not cast in stone because, for example, Americans in US GAAP, they see 10 elements of financial statements, but IFRS focus on 4 and on 5, and these 5 are assets, liabilities, equity, income, and expenses. First, let's talk about the assets, liabilities, and equity. These are the elements that feature in the statement of financial position. You've got the definitions here, and these definitions are worth remembering. Not that you can be asked for quoting them in the exam, because you won't be, but basically they are very good definitions, and once you remember them, it will open your eyes and facilitate understanding a number of concepts within IFRS. So an asset is a resource that is controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So 3 major elements of this definition is control, past event, and future economic benefits. So an asset will only be something that we control. Remember, not own. Actually, just a second ago we said that the balance sheet on the asset side shows things we own. Now actually, no, the things we control. This control must have been a result of past events, and last but not least, for something to be an asset, we must be expecting economic benefits in the future. Now let's look at examples of something that might or might not be an asset. If you look at a building owned by the company. Now the condition number 1, control. Does it exist? Well, definitely we own it. So yeah, how can we evidence it? Well, there are some deeds, there are some legal documents that will confirm that we own it and therefore we control it. Number 2, past event. What will it be? Well, we bought it. Yeah, we bought it some time ago. We've got an invoice for it or the documentation of work if we built it. And 3, future economic benefits. Do they exist? Are we expecting anything? Oh, definitely so. Why would we buy a building if we do not expect future economic benefits? It's either our office or our manufacturing premises, or we want to sell it and make a profit on it. Yes, we do expect economic benefits. Now, a similar analysis can be done for a car that we have for business purposes. Control, yes, we own it or we leased it. But if we have all the risks and rewards resulting from that contract, we still control it. All right. Past event, obviously we signed a contract or we bought the car. Future economic benefits, yes, if we bought it for the company, there will be some future economic benefits from that car. On the other hand, let's look at someone else whom you might be familiar with. And yes, these are all happy employees. This time, let's try and work it backwards. Will we have future economic benefits from employees? Yes. Was there a past event? Yes, we signed a contract with them. Do we control them? No. We don't control employees, all we have is a contract, but actually that contract from the perspective of the employer has a rather symbolic nature, because an employee can leave at any point in time, taking all his knowledge, everything he learned, and we will have to hire someone else and train him again. In the best case, we will have a notice period of 3 or 6 months, but still, an employee can freely leave at any point in time. So that is about assets. Liabilities. Now that must be a present obligation arising from a past event, as a result of which there will be some outflow of economic benefits. So again, 3 critical bits of that definition: present obligation, past event, and this time an outflow of economic benefit. The details of liabilities and liability recognition will be discussed later in your studies, because this is quite a complex area of financial reporting. Right now, just remember the key element here is the present obligation, and the key word of that key element is the word present. So we only have a liability, we only owe something to someone if we owe it now, not if we can possibly owe it if something happens. No, only if we owe it now. Finally, the definition of equity, it's just what is left in assets after deducting all liabilities. Right, so equity is the residual interest. Whatever belongs to the shareholders, whatever we owe to shareholders as a company, is just what is left when liabilities are taken off assets. In the statement of comprehensive income, we have 2 more definitions. Income, which is every kind of increase in economic benefits in the form of enhancements of assets or decreases or liabilities other than transactions with shareholders. And that's pretty intuitive, right? When shareholders pay some money in, that's not revenue, that's an increase in share capital. Similarly, an expense is any decrease in economic benefits during the period in the form of a decrease in assets or increase of liabilities other than distributions to owners. Quite obviously, if an entity pays a dividend, it's not an expense, it's a transaction with shareholders. It's, technically speaking, paying the money back to shareholders, and therefore it should not be included in the income statement.